We're talking central bank surprises with Gary Wagner this Friday. Gary, good to see you again.
Thank you so much. Happy Friday to all of you.
So, Gary, since the start of the year, the theme here has really been central bank surprises. It started with the Swiss, the Danish, the Canadians, and now yesterday, the Europeans announcing a much more aggressive QE program than expected. Do you think that the marketplace can afford these types of shocks delivered from the central banks?
Yeah, I mean, personally, I think that what we've seen is really healthy for the markets. We've seen volatility, there's no doubt about that. But these announcements, especially the announcement yesterday in which the European Central Bank announced a quantitative easing program which was more extensive than originally leaked out the day before, I believe on Wednesday, is something that I think is really going to ignite their economy at first. And I think that it's something that was really needed and is welcomed.
And now the question is, do you expect the Fed to surprise the market next week when they meet?
Well, they certainly could deliver a surprise to the market. Whether or not they will is another question. Realize that as of Thursday, the equities markets, Standard & Poor's, Dow Jones Industrial had gotten back all of the losses from the first of the year. So they're actually net positive on this year's moves. So in America, we've got the economy, which is pretty strong. Earnings came out, they were strong. And so I'm not convinced that we require in the United States the same kind of drastic action that they did in Europe.
Let's focus on gold now, which breached $1,300 this week, Gary. Many analysts are still expecting volatility for gold despite the uptrend we're seeing. How do you see it set up?
Well, I mean, you've got to separate volatility from price movement. Do I think we'll have continued volatility in the market? Absolutely. But on a technical basis, we have seen a defined trend as this market has moved up, and it's done so in a pretty quick succession. At the same time, you've had the dollar running incredibly strong, and you've got gold running in tandem with it. You've got the equities running in tandem. So the unusual circumstance that we're looking at this week, as we did last week, is that you've got equities stronger, gold stronger, dollar stronger, all at the same time.
All right, on that note, Gary, let's get to your insert. What have you brought to us this week?
Well, we're going to take a look at some of the key support and resistance levels currently in gold. We're also going to take a look, as we did last week, of a Swiss gold chart and then the Swiss euro, because that's really been the greatest impetus in terms of the effect this last real rally that we've seen in gold is what has happened over in Europe, Switzerland, and the ECB.
Fantastic. Let's get to it.
Call it the 1-2 punch, but last week's announcement in Switzerland by the Swiss National Bank to depeg the Swiss franc from the euro dollar, and this week's announcement by the European Central Bank to begin a quantitative easing program have certainly set the wheels in motion in the markets that we have been following. Gold has really rallied tremendously. Stock market in the U.S. has, it appears, come off of the most recent retracement and is moving back higher. And the dollar is hitting record numbers. We also have oil under tremendous pressure, trading currently at about $47 a barrel. The real question is what is the long-term prognosis for gold, and where do we think the market could go? The first thing is when we look at an extended chart, this is a weekly chart, and this really illustrates the tremendous breakout that we have seen occur over the last couple of weeks as this market barreled through this long-standing resistance line. When we consider the fact with a long-term rise in gold up to 1920 and then a correction back down to a 61% retracement or 50% retracement, now that we see that gold has absolutely held those numbers, the real question is how will this rally unfold? And the real exciting possibility is that we've actually concluded our major fourth wave, waves 1, 2, 3, a major fourth, which would mean we're going into a major fifth. Of course, a major fifth would be composed of 5 waves, but it would take us to substantially higher prices in gold over the next year to year and a half. One of the models that I do want to explore in more detail is the bear market truncation as it relates to our current state or price action in gold. I invite you to try the Gold Forecast, our daily video newsletter, during our free 7-day trial. It will allow you to get all 5 editions of our video newsletter next week, in which we will explore these various models. Again, our current bullish model in gold.
Thanks so much, Gary. And as always, thank you for watching this edition of Chart This with Gary Wagner. We'll see you next week.